Hey y'all, it's your favorite trader Jazz, and today I'm going to be doing a masterclass for y'all, and we have the whiteboard out today because that is how I'm going to be presenting the information. So I got my handy dandy markers and my rag, so let's get started. So today's class is called Forex Trading for Dummies, but why am I saying dummies? Well, because it's provocative and it gets people going. This is going to be a basic, I forgot, I don't have to yell, I have a microphone on. This is going to be a basic beginner's Forex class. So let's start off by making sure that you understand the basic concept of Forex. Forex is a nickname for foreign exchange. Why is it called foreign exchange? Because you are dealing with trading currencies. And it started with trading world currencies so that when you travel, you could be using the proper currency of the country that you travel to. So that's kind of how it started. And so Forex is just short for foreign exchange. The thing that you need to understand about Forex is that it's very basic in a sense of all we are doing is buying or selling for profit. Well, how do you make a profit off of buying or selling? So no matter which type of Forex commodity you are trading, you can only do one of two things: buy it or sell it. And now we have to talk about the current price of the exchange. So I will get into the different types of commodities in a moment, but we have to understand this basic concept. So let's say the price of whatever you're exchanging, whether it's the US dollar, Bitcoin, gold, whatever commodity you're looking to trade, it has a current price, aka a current going rate. So let's say that price is here and you decide that you want to buy this because you believe that it's going to go up. Maybe price has just been kind of going sideways for a little while, but price is never really sideways. It's really more so a look of reds and greens more realistically. But let's just say it looks like it's going sideways on the chart. You want to get in for a buy, right? So you would buy right here at this current price. So that means as long as price starts to trade above it, you are in profit. Now, if price starts to trade below it, you are not in profit. You are losing money. The wonderful thing about Forex is you can always get in and get out. There are no day trading rules, unlike some other trading industries like stock options. There's day trading rules. With Forex, you can always get in and get out. All right, so on the opposite end, it's pretty much the same thing with selling. Now, the thing about Forex that tends to trip people up a little bit is you can not only buy, but you can also sell to make money. So with buying, you want to buy if you think that the price is going to go up. If you think price is going to go up, you will be in the green when you buy. But you can also make money if price goes down because you can sell it. So you selling it, as long as price is going down, you will be in profit. So let's say that this is current price here. And again, this current price could be represented in US dollar, or it could be Bitcoin, or it could be, I think that's the euro sign, or it could be the British pound, whatever current price is, right? Let's say current price is right here, and you want to get in for a sell. Goes down, you will be in profit. So that is how you enter. You can either enter by clicking buy or by clicking sell on your trading platform. Now, how do you exit a position? Because you would think that, okay, if you're buying, then you would sell it to exit, or if you're selling, then you would buy it to exit. No, that's not how it works on Forex. With other trading instruments, it does work like that, but we're not going to get into that. To enter, you are buying and selling. To exit the market, you are closing. And that is the same for buying and selling. That is how you exit the market with your profit or your loss. You enter with a buy, close it to exit. Enter with a sell, close it to exit. And which one you choose to enter into depends on where you think price is going. You think price is going down, you're entering by clicking sell. You think price is going up, you're entering by clicking buy. Now let's talk about what you can enter into. So let's talk about the actual commodities that you can trade on the foreign exchange market. The main ones that you will hear about are currency pairs, metals, crypto. Down here, I'll put indices. These are the main commodities or things that you can trade on the foreign exchange market. What is a currency pair? A currency pair has to do with how Forex originated, which is trading one country's currency to another country's currency. Common currency pairs that you will hear are Euro USD, which is the European dollar, which is the European currency for the American dollar. The sister to that is GBP USD, which is the British pound, AUD USD, which is the Australian dollar for the US dollar. You'll hear JPY USD, a lot of USD, all right? We're very self-centered over here. And this is the symbol for those pairs. So when you're looking at the chart, which you need to look at in order to get in and out of the market, this is what you will type in to search for the chart. Metals, the main ones that you'll hear is XAU USD, which is gold versus the American dollar. XAG USD, which is silver against the US dollar. And you know what? This isn't a metal, but a lot of times it's kind of lumped into this category, which is oil. You've probably all heard of crypto. BTC USD is Bitcoin versus the American dollar. And then you have Ethereum and Cardano and all of that, but the main one that you'll hear of is Bitcoin. And indices, which is my personal favorite. So indices is an interesting word for index funds. Index funds have to do with the US stock market. So you can actually trade the US stock market on Forex through indices. And so my favorite indice is NAS 100. That is the symbol for the NASDAQ 100, which involves the 100 tech stocks. And as we know, well, you may not know, tech is big business right now. And so this chart is very, very active, which makes it a heavy hitter to trade. You can make a lot of money with this chart. I actually have dedicated a mini course called Forex Fast Track that teaches only NAS 100 and how to trade, the strategy that I use, when to get in, when to get out, all of that. And it's just with NAS 100 because honestly, you can make all the money that you could ever think about making with Forex using the NAS 100 chart. And so I've dedicated an entire mini course to that called Forex Fast Track. It's a 2-hour in-depth course, and I will put that link in the description box below. But NAS 100 is my favorite indice. You will also hear US 30 USD, which is also a very tech-heavy index fund. And so those are the two main ones that you'll hear. Some of the other ones are not as popular and actually are broker specific. If you want to jump into Forex trading without feeling overwhelmed with all the information out there, let me introduce you to Forex Fast Track. This is a mini course that's all about action, especially if you are interested in trading NAS 100. In this mini course that is about an hour and a half long, I'll show you how to set up your trading environment, how to use TradeLocker step by step, and most importantly, how to trade NAS 100 with my proven strategy that you can start implementing right after the course ends. Learn how to make deposits, execute trades, and even withdraw your profits, all in one streamlined course. Whether you're a beginner or looking to sharpen your skills with another strategy, Forex Fast Track has got you covered. Don't wait. Grab Forex Fast Track now, and let's get you started trading profitably today. Now, when it comes to buying and selling, you are going to need to know 3 different terms, and that's pips, lots, and leverage. Why do you need to know these, and what does this mean? So pips is actually how the movement is calculated on Forex. So as we just went over, there are different types of commodities with Forex. You could be trading cryptocurrency, oil, the stock market, the Australian dollar. There's so many different things you can trade, and they all have their own measurement system. So think about the imperial system versus the metric system. How in the US, we measure things a certain type of way using different names and terms versus the metric system and how they measure things using different names and terms. But it's the same distance, right? It's the same difference, it's just a different name for the measurement. Well, for Forex, to simplify it, because you're measuring so many different things, they measure the movement of how much something moved on the chart, how much something moved in price by pips. So pips is the measurement name. That is how you measure price going from here to here. That distance is measured in pips. And they have different pip calculations for every single trading pair. And there are pip calculators online, and the broker that I use does all that calculation for you, so you don't really need to know it. But if you are interested or want to just kind of do it on your own just to learn it, I teach it in my Market Money University course, and you can also use a pip calculator online. Now, lots. What are lots? Where pips is the measured move, lots is the size that you buy or sell. So for instance, instead of saying, I want to get $100 worth of Bitcoin, because this is a world exchange system, you can't really say $100 worth. So to simplify everything once again, they say lots. So everything is measured with lots. So you can say, I want to get 0.01 lots of Bitcoin. And that lots is the same across all currencies. So the reason why they have these different names is to simplify it and to make everyone on one accord, since we are dealing with world currencies. if you want to know, hey, I still want to only buy $100 worth, so how many lot sizes is $100 worth? Again, there are lot size calculators online, and my broker actually does all those calculations for you as well. So you buy in with the lot size, but it tells you right next to it how much money that is in dollar amount, so you don't have to guess. So my trading platform completely does that. Don't worry too much about having to do that calculation yourself. Leverage. Leverage is basically your loan. Basically how much money you are borrowing. So we're just going to go ahead and put loan. Anytime you trade Forex, you are trading with a loan. So yes, you have to have your own capital. However, when you are buying these lot sizes, you still are giving leveraged funds in order to trade. How much leverage depends on your broker. An example of a low leverage, which is a less risky leverage, is 1 to 200. A higher leverage, which is a more risky leverage, is 1 to 500. When you sign up with your broker, you get to choose which leverage you want. If you want to be on the safer side and become less likely to blow an account, then you would choose a lower leverage. If you want to be more risky and have more money to kind of play with and get more wiggle room, then you would choose a higher leverage. When it comes to flipping money super quickly, and we hear stories of people flipping $50 to $5,000, they're using a super high leverage to be able to do that. You can't do that in a short amount of time with a lower leverage. However, with a lower leverage, slow and steady wins the race. So they both have their pros and cons. It is up to you. Now let's talk about brokers and trading platforms for a moment. Now, when you are trading Forex, you are going to have a broker that you trade through and a trading platform that you trade on. These two go hand in hand. The first step is to get a trading broker. The second step is to choose a trading platform. Basically, a broker is who holds your money, and your trading platform is who trades your money. The broker is where you are going to do your deposit, your withdrawal. The trading platform is where you're actually going to be buying and selling these lot sizes that we talked about. The trading platform is usually mobile device. That's what you're trading on, and that's where you see all the charts. You can get in and get out. You can log into your broker on your mobile app, on your mobile phone, or on a desktop. It doesn't matter, but it's usually a website. That's basically the bank for your money. That's where you are going to deposit and withdraw your money through your broker. Your broker is also going to be in charge of what you can trade as well. So they decide what you trade and the leverage that you trade with. Your broker is in charge of that. But like I said before, you can choose your leverage. So they are in charge of what you trade. Not all brokers allow you to trade indices. Not all brokers allow you to trade crypto. Platform is just for trading. Your broker handles everything else. And your broker will give you a trading platform that they are partnered with for you to trade through. Some of them have a couple options for you to use, and some of them are just one. Like my broker, it only allows me to trade with TradeLocker, which I'm totally fine with because I absolutely love TradeLocker, which is the name of my trading platform. Now, another thing that your broker regulates is the commissions. I don't know if I spelled that right. But they're in charge of the commissions. In the Forex world, we call that spread. So now let's go ahead and clear this off and go over quickly what is spread. Think of spread as the broker's bread. It's basically the broker's cut. That's the amount of money that they're getting for every single trade that you take. And the spread is going to also depend on the lot size as well. So the more money you're trading with, the more of a cut they're going to take. And you can see, depending on your trading platform, you can see clearly the spread by looking at the difference between the bid and the ask. On MT4 and MT5, which is a very popular trading platform, it'll actually tell you bid, ask, and it'll show the difference in price. And that difference is the broker's fee. On my platform, it shows me how much in dollar amount, so I don't need to calculate the price difference. And it also shows me on the chart. So for instance, let's say price is doing its thing, it's doing its thing, and you want to get in right here. If you click buy right here, your broker will enter you right now immediately, but the price that it'll enter you at is right here. So slightly above the actual price point that you want it to get in at. And so the difference between here and here is the bid and ask or the spread. That difference is the fee that your broker is taking for allowing you to trade with them and trade on their platform. for easy numbers, let's say that is a 10-cent difference. That means that for that trade, you're being charged 10 cents in, and usually when you close it, it's going to be another 10 cents out. And so you can also look at your fees clearly when you look at your closed positions on your trading platform as well, so you can see just how much it's charging you to get in and get out of these trades. But that's why it's not a good idea to constantly be trying to get in and out, in and out, in and out, in and out of the market, because every single time you're in and out, you're going to be paying that spread. It adds up over time, and every single broker has a different spread, has a different commission fee structure, so it is something to look into when you are choosing your broker. Let's actually talk about choosing a broker. So I'm not going to go too much into this because I have an entire video dedicated to it, and I also go over this in depth in my course and also get you guys set up on the broker that I use. But when it comes to choosing a broker, you're going to hear two words: unregulated versus regulated, also known as offshore versus US based. So American traders and even Canadian traders, a lot of North American traders in general like to go with US based brokerages. I am a US based trader, but I do not go with that because they do not allow me to trade what I need to trade, okay? The regulations that come with Forex brokers, if it's a regulated broker, they had to pass a lot of US standards to get their regulation status, which is great if you are concerned about not being insured by FDIC and all of that. So if you're trading like hundreds of thousands of dollars and you have that just sitting in your account, then maybe that's something to look out for. For me, I would never have hundreds of thousands of dollars sitting in my trading account. But a lot of people just feel more comfortable going with a US-based broker. Now, the thing with the US-based broker is it's high fees. So that spread thing that we were just talking about, big time, big time. Low leverage. That's another issue I have with regulated brokers, is they offer low leverage because in order to have this regulation status, they don't want a lot of risk going on their brokerages. So to minimize risk, they offer a low leverage. But with low leverage, you can't really flip accounts the way we be trying to flip accounts, you know? So I'm not really a fan of the low leverage. I need me some leverage, you know what I mean? I like leverage. That's why I'm on Forex. Otherwise, I just continue to trade stock options. You know, there's so many things to trade. One of the things that entices me about Forex is the leverage option. So I want it to be a pretty good leverage. Regulated brokers do not offer a good leverage. And then the other con issue is you can pretty much only trade currency pairs and metals. Again, the reason for that is they try to minimize risk on their brokerages, so they only allow you to trade just the basic currency pairs and metals. Most regulated brokers do not allow you to trade cryptocurrencies and indices, which, I mean, count me out. That's what I trade. So unregulated brokers, which are offshore brokers, so this can be UK based, it could be an island based. You got to look at where your company is based at. The exact opposite of the things that I listed here: low fees, high leverage, and you can trade everything. So I'm just going to put like a little symbol, like an up symbol. Like you could trade everything, okay? So to me, it's a no-brainer to go with an offshore broker. Want to take control of your trading, whether you're on the go or stationary? Meet TradingView, the ultimate platform for technical analysis. Whether you're on your tablet, laptop, or mobile phone, have access to virtually every chart there is with almost every broker, and analyze markets like a pro with the state-of-the-art charting tools. Stay connected on the go with TradingView's mobile app. Make informed decisions with real-time data and alerts. Join millions of traders using TradingView and start your free trial today. Okay, now let's talk about the 3 different types of trading accounts you can have. 3 types of trade accounts that you can have are self-funded, demo, that's the second one, and then company funded, also called a prop firm. Sorry if that's a little messy. A self-funded account is pretty much you trading with your money. Pretty simple, right? So you go through a brokerage, you deposit money, you trade with it in the trading platform, and 100% of your profits are yours, it's your money. But if you lose it, that's also on you as well because it's your money. So the self-funded route is personally the route that I have been going all of this time, but there's a lot of cons with that. You know, obviously risking your own money Comes with a lot of cons. I've taken a lot of losses. I've blown accounts, which means I've lost all of my money. But it's also super rewarding as well when you make a lot of money and flip a small amount of money into something. So it goes both ways. But for me, this is just the route that I've always gone. I trade with my own money, and any money that I lose along the way or have lost along the way, I consider it me paying tuition to the market. That's how I consider it. Like, people spend way more money than I've lost going to school and having loans and things for their career. So if I'm losing some thousands here and there, I'm okay with that when this is my career, right? The next type of trade account you can have is a demo account. So a demo account is when you are trading fake money. I mean, that's pretty much what it is. You're trading the real charts. You are using the same functions as if it was a real account, but you're trading with fake money. So basically, this is for practice. And I recommend everybody get started with a demo account. It's free. Practice everything that you learn with trading on a demo account first. When you feel like you're taking more wins than losses, then move over to self-funded, right? So you can always try any of these at any given time. You don't have to choose one and stick with it. You can always switch back and forth from whatever you want to do. But I think that everyone should at least start with a demo account. Even if you decide to get someone's course or really grind and find information yourself on how to actually trade, as you're learning, a big tip that I give to a lot of my students is, as you're learning the information, practice with a demo account. Not only does that help you practice and get used to what you're really going to be doing in making real money, it also helps ingrain a lot of what you just learned, hands-on practice it in real time. So I find that to be very, very helpful. Now, last but not least, you can also trade a prop firm. Trading with someone else's. My handwriting is trash, okay? I mean, if you haven't already noticed, but it's so bad. I look at it sometimes and just like, wow, get it together. When you go the company funded route, you are trading with someone else's money. Now, this does not come free, and this does not come easy, all right? It is a luxury. You have to earn this, and how you earn it is with challenges. So every prop firm has a challenge that you have to pass. And what a prop firm challenge is you have to sign up with them. You have to pay for this. Each challenge costs money. How much it costs depends on how much of an account you're trying to get. So if you're trying to get a $100,000 account, it's going to cost this much. If you're trying to win a $500,000 account, it's going to cost this much. But after paying the money for the challenge, you then have to go through a series of pretty much tests. And what these tests are is to prove to the company that you're trying to get funded with that you are a profitable trader and that you're not going to mess their money up. They're not just going to give it to you. You have to show them, hey, I'm a consistently profitable trader. I'm not super risky. I don't gamble. I know what I'm doing, and I can make y'all some money and me some money too. So not only do you have to pay into the challenge, and a lot of them you can take the challenge over and over again. So not only do they get money off of that, but they also get a percentage of your withdrawals. So let's say you pass a challenge and great, you get granted a $150,000 account. You're trading with that account. They also have rules for that. So like you can't risk more than like 2% on every trade. You can't be in 5% drawdown at any time. You know, they have rules. You have to follow their rules. It's their money. So you got to play by their rules. And let's say you have a profitable week, and at the end of the week, that $150,000 account that was granted to you is now at $160,000. So that's a $10,000 profit. Well, that $10,000 profit is not all yours. Let's say you wanted to do a withdrawal. 30% of that is going to go to the prop firm, and then 70% will go to you. There's also some prop firms that do a 90-10 split, which is great. So 90% of the profit goes to you. So each one has a different way of doing things, but either way it goes, they are getting a cut when you withdraw your money as well. But it's worth it because who has $150,000 of their own money to trade with, right? So if you don't have any money, but you only have enough to buy and pass a couple challenges, then going the prop firm route will be for you. So that's pretty much all I'm going to go into for this video. But just know that there's so much more to learn about Forex. We have not even touched on fundamental analysis, technical analysis, risk management, trading strategies, your trading plan, trading psychology. There's so much more to learn. I have a 25-hour plus course video style content. It's not whiteboard stuff. It's a totally different format, and it's super beginner friendly, A through Z. Not only how to become a profitable trader, but the exact strategies to use in your everyday trading. I love this course. I'm very, very proud of it. It's called Market Money University. You can find a link down in my description box below. I also have a trading Discord called Market Money Multiplier, and we trade there every single day. We trade Forex, stock options, and I'm getting into futures. And yeah, so if you want to trade with me, go ahead and check out my links down in the comment section and the description box. And if you like the video, make sure you give it a thumbs up, and I'll see y'all in my next video. Bye.